All right, so what do we have here? This dollar bill represents your retirement nest egg. Everything you've saved for, everything you scrimped for, everything you put away for the last 10, 15, 20, 30, 40 years into your 401k plans, your IRA plans, your Roth IRA plans, pensions, 401ks, home equity, and so forth. It's your total net worth. But what's wrong with that picture? Well, we have this thing called the government, the IRS, and they always want, you ever heard the saying, oh, well, half of it is really theirs? And it's kind of true, isn't it? So what happens is we have this thing called federal taxation, and they want to kind of take money from you, and we have these state taxes. So the state is taking a little bit of a bite out of your money, and then we have these local sales and property taxes. Tastes like dough. So it all kind of adds up and it takes a bite out of your retirement nest egg. So what we try to do with a little bit of fancy tax plan is we try to cover up that hole, but oftentimes, throughout the year we'll go, okay, well let's do this and that to change our budget or withholdings to try to cover up that gap in our planning. But then that tax bite always seems to show up at some point when we do our tax return, or government wants their piece, right? And so what we want to do through the power of tax advantage investing, tax deferred investing, and the magic of financial planning is we want to try to make that whole. Okay? Pretty fun, huh? I always got to start off with something fun. All right. Good to have you here this evening. And our learning objectives are to talk about 2018 tax regulations. So we're going to talk primarily about 2018 and the tax law changes, and we're not going to be looking backward too much at 2017. 2017 is behind us already, and so most of the taxes that we have due and most of the tax damage and problem is looking forward, right? So you're going to have more taxes due in the next 5 years, 10 years, 20 years, 30 years than you are for 2017. So we'll focus most of our attention on tax forward planning. We'll talk about the new tax rates. We're going to get into minimizing taxes, looking at tax tools and strategies, and our whole goal is that you'll have more money, more income to spend throughout your retirement years. We'll also go through a little bit of tax mapping, which is something new for a lot of you in here. As I go through the material, feel free to ask questions as we go along, and I'll try to address them as time allows. Sound pretty good? So Andy had mentioned that I'm a certified financial planner. We have 4 certified financial planners at our office. You can come on right up here. And the certified financial planner program is actually, we have over 1,000 integrated financial planning principles and disciplines that we have to learn throughout that 3-year period. Most of my time, I would say 90% of my time, is spent in the area of investment planning, tax planning, and then retirement savings and income planning. So most of my time is spent on this end of the spectrum. But other areas that we do work with would be estate planning, different professional conduct and regulation. We look at general financial planning principles, education planning, so people that are trying to set up like 529 plans for their grandchildren, we help a lot with that, or their children. And then we also work in the area of risk management and insurance planning. So when it gets into Medicare premium and supplemental policies, what to do with life insurance policies, long-term care, I also have training in that area. One of the words that keeps popping up in the news media these days is fiduciary standard. Have you guys heard this? So we have clients that are coming in and saying, are you guys a fiduciary? And yes, we are, because we are Series 65 licensed. And a fiduciary, the main goal is just putting our client's interest first, our client's best interest first. And so as a certified financial planner, I'm already a fiduciary, plus we do have a Series 65 license. Whoever you work with out there, just make sure that they are a fiduciary and putting your interest first. Now, adding a little bit of color to this evening and a little bit of some fun stories and just to liven it up a little bit. A little bit about my background. I've, have all this educational stuff behind me, but I learned a lot and probably most about the fundamentals of investing from my parents. So this is my parents. This is Pat and Karen. And my dad, he was a Minnesota conservation officer up on Lake Vermilion for 30 years. And my mother, she was a social worker for the county. So she was a stay-at-home mom. And then after my sister and I got older, she went to work for St. Louis County and worked for 20 years, retired at 62. My dad retired at 58, early retirement age. And so they both retired early. They're married for 45 years. There won't be a 50th. I lost my dad to cancer about 6 years ago. And one of the things that my parents taught me about money, and one of the things I never heard them talk about, is the fear of running out of money. So you're probably going, okay, well, living up on Lake Vermilion, you can be pretty dang conservative and cost of living is very high up there and so forth. But they did a lot of things. They traveled quite a bit. They always had good things, cars and boats, and paid for both my sisters and my college education expenses. And so they lived pretty good. It wasn't because they were really conservative. But they didn't fear about running out of money because of why or what? Pensions. Exactly. That's easy. If you have a pension and Social Security, it gives you a lot of security. And so my dad, he had Minnesota State Retirement System. My mother had Social Security and para benefits. And so it was easy for them because they always had this steady, reliable, consistent income coming in. And so I learned it's not about creating the biggest pile of money. It's about having guaranteed increasing cash flow throughout one's retirement years. So we always feel that's important for our clients in the event of, that great big button on the president's desk that's bigger than somebody else's button. If you ever had to press that, at least you have some guarantees in your portfolio. Other things that they taught me about is minimization of taxes. I always remember my dad scrimping together enough money every tax year to put money into an IRA account. Remember the IRAs back in the 1970s? You could put in $1,000 or $2,000 on a pre-tax basis and get your taxes down to as low as possible. They always did that, and so it was always important for them to, save first and spend later. Other principles that they taught me that I always remember is, this one kind of brings a point home, is when I was growing up, my dad bought me 500 shares of International Dairy Queen stock, and that $500 investment went to over $10,000, and so it paid for my college. And so when you're a kid and you see $500 go to $10,000, you go, that's an easy way of making money, right? So that's kind of what you want. That's what brought me into the business. And in 1990, I learned a valuable lesson about investing. In 1990, so I'm in the business, I started in 1989, that's 29 years ago. And my parents, they said, okay, well, you can manage some of our portfolio, but 1990, the stock market went down. And my phone rang, and I knew it was my mother on the phone, and I was like, oh my God, she's going to be so mad at me because I'm so smart. I have a 4-year college degree, all this licensing, and I didn't tell her to take her money out of the market before it went down. I kind of felt guilty about it. But she said, Sean, the market's down. Buy me 100 shares of Dayton Hudson stock. I've been waiting for the price to go down. It's like, oh, okay, yeah, that makes sense. You buy low, right? Sell high. Later on in the afternoon, my dad called and he bought more Best Buy company stock. Remember Best Buy? If you bought it back in the 1990s, it's pretty good investment today. So that went up a lot in their portfolio. So lessons like that, you kind of learn along the way, and kind of fun stuff, and so it gives you some fundamentals in investing. What do you think this couple here is doing? Trying to log into their computer, forgot their password? My example here, they're doing their tax return. They're a little frustrated by all the new tax law changes, et cetera. So how many people in here do their own taxes, just out of curiosity? Probably about half the group. Okay, good, yeah. How many people do their taxes by hand without using a software program? Yeah, few left. Is it easy? No, not necessarily. It takes a little time, right? Yeah, especially when all the tax laws change and you have to learn a little bit something new, or if there's new tax credits or new this or new that. So most people use some sort of software program or have a tax professional helping them these days. One of the things I'll comment about tax returns and software programs, most of them basically show you what the damage is from the prior tax year, and it doesn't do a lot forecasting into this year that you're in right now. So what we want to do is spend more time forecasting where to reduce your taxes into the future for this year, next year, and going forward. And so we'll talk about tax mapping tonight and how that works for you. And we do this already automatically for our clients. So I always like this quote. It's from Dave Barry. Says, "It's tax time. I know this because I'm staring at the documents that makes no sense to me no matter how many beers I drink." So we're going to start off with the basics, and then we'll build upon the basics. So tonight we're going to talk about the marginal tax brackets, married and for single, and then we'll talk about capital gains and qualified dividends, the tax rates for those. We'll roll into Social Security taxation, required minimum distributions, and the deductions, exemptions, and tax credits. So quite a bit of ground to cover, but we'll start at the beginning here with our marginal tax brackets. These, these rates up here, we did give you a handout. And the charts that you have in front of you will show how much you can put into retirement savings plans. Does anybody need one of these? Okay. Say, Eric, could you grab some more of these? Or you have one for Bob right here, thanks. And we have more at the front desk if anybody needs one. It'll show what your contribution limits are, what the full retirement Social Security amounts are going to be, Medicare premiums. So the more income you bring in, the more it can raise your Medicare premiums on a year-by-year basis. So you got to keep an eye on that. Where on the back side of the page here, it has the different tax rates for long-term capital gains and qualified dividends. And then in the bottom left of your chart, it'll show the tax schedules. So the tax schedules are going to flow right along with the charts I have up here. And I'll have your attention up here instead of the charts in front of you. You can take these home with you. And then on the lower right side of the page, it has the standard deduction amounts. And in addition to that, it has the elderly or blind additional deduction. So take a look at that for 1 minute. Do you see where it says elderly or blind additional deduction? It has single $1,600 and married $1,300. So this chart has one thing, but other resources have another thing. So right next to the single, write $1,550, and the married filing jointly, write $1,250 under the elderly, because we're not sure which one it is, but I'm pretty sure it's the $1,550 and the $1,250, and I'll use that in my examples up here. So, $1,550 for single taxpayers, $1,550 for single taxpayers, $1,250 for the married filing jointly. And so there's still, because the tax bill is so new, there's still a little bit of conflicting information out there. But most, the examples I'm going to use the $1,550 and the $1,250. Elderly would be 65. Thank God, right? Yeah. So 65 or blind. Okay. So the 65, if you're 65 and your spouse is not 65, you only get one extra standard deduction. So once you're both 65, you get two extra deductions. All right? Now, how the married filing jointly brackets work, what we have here is income up to $19,050 is at a 10% tax rate. Anything over $19,050 up to $77,400 goes to a 12% tax rate. And then above that 77,400, we go to a 22% tax rate all the way up to 165,000, and then it goes up from there. And you can see here what the brackets were last year. So do you notice that you have a tax cut? It's about 3% reduction in the marginal tax rates. That all makes sense? For single taxpayers, it's basically about half of what the married filing jointly is. So when I'm going through my examples up here, if I'm using an example of a married filing joint, if you're a single taxpayer, just cut the numbers in half. Just use 50% of that example. So single taxpayers, these are your rates. Okay? They brought back more of the married filing jointly tax penalty. Because did you see where the 37% tax bracket starts for married filing jointly? It starts at $600,000, but for a single payer, it starts at $500,000, so it's not half. So we're finding that the single taxpayer actually has more advantages right now. So. Okay, so here's a question for you. Suppose you were at the top of the 12% ordinary income tax bracket, and you had more earnings that pushed you into the 22% bracket. So let's say that you're at, what is the married filing jointly? What is the cutoff? 77,400, is that correct? So let's say you're at 77,400 of income, and then your employer, your boss says, hey, we're going to give you a raise. We're going to give you a raise to 77,500 for this year. Now you're going, oh man, that puts me in a 22% bracket. So here's a question for you. What's the impact on your tax bill? Would your bill go up substantially, or would your tax bill go up a small amount? Yeah, good. Yeah, it's actually, that is correct. It goes up a small amount because it's a progressive tax rate. So what happens is the first portion of your income is taxed at 10%. The next piece is taxed at 12%. And then once you go above the 77,400, that portion is taxed at 22%. So this is the very first point I want to make is it's a marginal tax rate. So we want to focus tonight on what is our marginal tax rate on new money coming into our investment plan. Okay? Not our effective tax rate, our marginal tax rate. So another way of looking at this would be, or where to find this, first of all. Jot this down. If you look at line 43 of your tax return, line 43 shows you what your taxable income is. So if you look at your line 43, and it indicates, well, our taxable income is $170,000, well, your marginal tax rate is 24%. So all new dollars coming in plan would be taxed at 24%. And these are only the federal rates. In addition to that, we have our state of Minnesota tax rates. Okay? Here's another way of looking at it. It's just an easier way of looking at it, easier way of visualizing it and conceptualizing how the tax brackets work. We have a 10%, 12%, and then it jumps to 22, 24, 32. And so we have kind of a steps as we go up. And we'll be using these tax maps throughout tonight. Do you notice that there's this gap right here? It goes from all the way up to about $24,000 for married filing jointly. So there's a portion of your income that's a 0% tax rate. Did you know that? Why is that? No tax on that portion of your income. Deductions, right. Yeah, so you have deductions and exemptions that you're offsetting your income with, so that portion is actually tax-free to you. Okay, so we'll go through the deductions and exemptions. Marginal tax rates, once again, the tax bracket your last dollar fell into. Capital gains and qualified dividends get different tax treatment. So a capital gain would be on something like a stock or real estate investment into a business where the government is saying, okay, you're taking risk with your money to invest into that capital asset. So what we're going to do is if you have a gain or loss, we're going to give you a little bit different or special tax rate on these dollars. All right? So if you hold an investment for under 12 months, it's a short-term capital gain or capital loss, and it's usually taxed as ordinary income at the ordinary income tax rate. So there's no special tax breaks on that if you're holding it for under 12 months. If you're holding the asset for more than 12 months and you sell it and you have a capital gain, then you're going to get special tax treatment. And how that works is there's a 0% rate, 15% rate, and a 20% rate. So do you see this 0% rate? That goes all the way up to about $100,000 before you pay tax on that capital gain. It's pretty good, huh? That's a lot of capital gain one can take without any taxation. Huge tax break. So where does that come in handy? How many people in here have employer-held stock, employee stock purchase plan, stock in their 401k plan? And so where you can use this tax law and tax break, I'll give you an example. We have a lot of Medtronic employees that we do work with and retirees. And so if I have a Medtronic employee that has, let's say, $100,000 of stock in their retirement plan, their 401k ESOP plan, and let's assume the employer originally contributed $10,000 into the plan. So at retirement, the employee can take the money, take the stock out of the plan and put it into their own brokerage account. Don't roll it over, just take the stock, put it into your own account. The government says, okay, we're gonna tax the original $10,000 as ordinary income, okay? So you can't avoid that. But the $90,000 capital gain, long-term capital gain, gets these special tax rates, okay? So if I have somebody retires and has a lot of employer stock, I'll say, well, early on in retirement, you could be taking capital gains at a 0% tax rate. That's pretty cool. You can go for quite a few years at a 0% tax rate, depending upon how much stock you have in your plan, and just kind of use that as a tool. That's called our NUA tax laws, net unrealized appreciation tax laws, for employer-held stock in a 401k plan or ESOP. Now, I'll tell you a story about this. I had a gentleman that came to our tax workshop at Shoreview Community Center last November, and he had acted on this NUA tax law, and he took his employer-held stock, his $375,000 of stock, took it out of the plan because that's what the advisor had recommended on the end of a 1-800 number. So 1-800, Fidelity. Not to leave the company nameless here. So he took their advice. He took the $375,000 of stock out of the plan, and that was 100% of his 401k plan. It was all employer stock. He never diversified it. And that was 100% of his retirement account. That's all the money he had for retirement. Now, he has the stock, but then 2 months after he retired, another company came along and they said, hey, we're going to buy your company out. So it was Valspar, downtown Minneapolis. Sherwin-Williams bought them out. It was public information. Everybody knows that they're going to be bought out by Sherwin-Williams. Everybody but the guy at the end of the 1-800 number living out in Boston didn't know that. So what happens? Stock gets bought out, and he gets a new share of Sherwin-Williams stock. He has to pay a capital gain on $375,000, all in one tax year, 2017. So we calculated he'll lose about $175,000 of his retirement account to state and federal taxes. His Medicare premiums, what a drag that is. Now it's like $400 and some a month instead of, a very low amount. It's disaster. Let's talk about deductions, exemptions, and credits. The deductions have changed dramatically from 2017 to 2018. So the new standard deduction for single taxpayers is $12,000. For married filing jointly, the new standard deduction is $24,000. And then if you're over age 65, it's an additional $1,550 if you're single, and $1,250 per person if you're married filing jointly. Okay? So the standard deduction has gone way up. Alrighty? Now, if you don't want to use a standard deduction, you can try to itemize on your tax return. You guys familiar with itemizing? What are some of your itemized deductions, typically? Charitable contributions, medical, mortgage, interest on, or real estate taxes, interest, mortgage interest, state income tax. Okay, those are the biggies. All right, so check this out. State and local property tax up to $10,000. What does that mean? Well, if you're a dual income couple, if you're making a couple $100,000 a year and your state of Minnesota income taxes are $18,000 a year and your property taxes are $10,000 a year, so last year you could take $28,000 of itemized deductions. This year they said, nope, you're capped, $10,000, that's it. Not good. So if you're bringing in wages, have high property taxes, it's limited to $10,000 as an itemized deduction. So if you're in a highly taxed state like Minnesota, California, New York, New Jersey, and so forth.
Does that include sales tax, like if you bought a car or something?
For this cap, yeah, SALT, state and local taxes, yep. So that's a real loss. What's ending up happening here, it's a kind of almost going to force people into the standard deduction instead of trying to itemize. Mortgage interest, there's caps on that. If your old mortgage is $1 million, then the interest on that $1 million mortgage is deductible. The newer mortgages is capped at $750,000. So you might be going, oh well, it doesn't affect us. But people, in states where the real estate values are more expensive, that's some limits there. The other limit that we're talking about a little bit earlier, Maria and I were talking, is on charitable contributions. And so like, let's say you're gifting, $5,000 to a nonprofit each year. And you're using that as an itemized deduction, adding up, all these different things, and it exceeds your standard deduction. Okay, well, yeah, you can write off that gift to charity. But what if your standard deduction is higher than the amount you're giving to charity and the amount you're itemizing? Can you still write off the charitable contribution? No. So that's a loss for nonprofit organizations because a lot of people can't itemize it anymore. They're just doing a standard deduction, gifting it, but there's no write-off. Okay? One of the workarounds on that is if you're age 70 and a half and taking required minimum distributions, you can have your required minimum distribution go directly to the nonprofit, and that way it's 100% deductible because it never shows up on your tax return. So if you take your RMD and as income and pay tax on it and then gift money to a charitable organization, there's no write-off. But if you just have that RMD go directly to the charitable organization, well, never showed up on your tax return. So it's 100% contributed without the middleman, the government. So it saves you about 30% of taxes. Maurice.
Does the entire RMD have to go to the charity to qualify, or can you portion out, like say 50-50?
Yeah, question is, does the entire required minimum distribution need to go to the charity, or can you split it up or portion it out? You can portion it out or split it up any way you so choose. So we have clients that come in and they'll have $500 going to their a church camp, and they'll have $2,000 going to their local church, and they'll have $1,000 going to their alma mater. So you can send these RMDs any place that you want. There's a special form that you'd fill out before you get, and just have the RMD go direct.
But can you keep any of it?
Yeah, absolutely. So you could have, 1,000 going here and take the rest for yourself. So it's completely up to you. The other workaround that we're hearing is if you're gifting to nonprofits, maybe double up or triple up on your gifting in one tax year, and then the following tax year, maybe you wouldn't give or gift to that organization, and you're just using that standard deduction. So one year you can gift as much as you can to be able to itemize it, and then the next year just reduce that gift down. So that's kind of what's going on. Win-loss for people, I don't know. You know, the tax returns and projections we've done so far, for most people, they're kind of staying about even. If you're working and still bringing in wages, your tax rates are likely going to be going up, all right? So be prepared for that. There's an article, everybody see this article in today's Star Trib about taxes and stuff like that? Okay, I won't even comment on it then. Basically, no, they're talking about, they just said, oh, the tax cuts are for the wealthy. However, they're polling people. So they came up, they say, Mike, who these tax cuts benefit? Well, the wealthy. You know, everybody's going to say that. But in reality, the taxes on the wealthy have gone up a lot because they can't deduct their SALT taxes on their federal return. And so that it's a real drawback. All right, so if you can't see it back there, here's Santa Claus being at the auditor's desk, says, you gave away 60 billion toys and you did get one receipt? He's in a little trouble. Okay, let's talk about exemptions next, all right? It's going to be a very short conversation. That'd be that. Yeah. So like last year, I mean, I was working with one of my clients, and she's single but has 5 exemptions. And you go, well, how can that be? She's single, well, actually, she's single, retired, and 5 exemptions. Her daughter has a medical condition and isn't working right now, and her daughter is in a nil tax bracket, but she has 4 grandchildren, and she takes an exemption for all 4 of those grandchildren because she says, well, I support those grandchildren more than my daughter does. And so she'll lose 5 exemptions on her tax return. So there might be some tax credits for children, but you know, again, it's all changing there. So that's that. Those are gone. There are some tax credits. There's healthcare tax credit, earned income tax credit. Education credits, one of the things that you'll want to jot down is there's this thing called a 529 college savings plan. And if you invest into it, your money compounds. It's not your money. You're actually investing into it for a family member, like primarily grandchildren, or maybe children. Maybe some people in here still have their children at home. But you're investing into it, and then it grows tax-free as long as it's used for higher education for a family member. So the state of Minnesota has a tax credit right now. They just started it last year. So if you put in a couple $1,000s, then the state is going to be giving you a $1,000 tax credit. So it's like put in 2,000, get 1,000 back. So it's a good deal for that tax credit. Let me show you another tax credit that's pretty cool. In this example here, we have a taxpayer that has $38,000 of income. And then from that, they're subtracting their deductions, $24,000 plus they're over age 65, so they get that additional $2,500. And then of that $38,000 of income, they have some earned income because they're doing a part-time job. So they're still eligible to do an IRA contribution, either pre-tax or a Roth. So they're putting a couple thousand away into an IRA. Now they got their taxes down, or their taxable income down to $9,500. And if it's at a 10% tax rate, it's $950 a tax. But what they decided to do, they said, well, let's put money in that, because we put money in that IRA, we get a $1,000 tax credit. And so that wipes out our tax bill. Put in $2,000, they got a $1,000 tax credit. So it's almost like a match from the government. They could always take it back out of the IRA. So be sure to think about these tax credits while you're doing your tax return year by year. Okay? Here's Homer Simpson doing his taxes. Marge, if anyone asks, you require 24-hour nursing care. Lisa's a clergyman. Maggie is 7 people, and Bart was wounded in Vietnam. We got all the deductions we possibly can. So, real tax system, we have a lot of other things we have to deal with. RMDs, taxation of Social Security, alternative to minimum tax. I'll dig into a couple of these here, and we'll start with RMDs because this is something, all of you hopefully will eventually have to deal with. And so what is a RMD, first of all? It's a required minimum distribution. Required minimum distribution from your retirement accounts, okay? So y'all probably know when you're in the year you reach 70 and a half, you're supposed to start taking money out of your retirement accounts. So the government says, okay, build it up, invest. You have your nest egg, your retirement accounts, but the government says, okay, you've gotten to use all our money over all those years. Now we want something back. So they say, okay, you need to start taking money out of these accounts and paying us back some of those taxes. And so in the year you turn 70 and a half, when do you have to take that first distribution? Right, Morris is right. Actually, yeah, you're right there too. Okay, so the first year you get a special exemption so you can skip your first year withdrawal, but then you need to do 2 the following year, okay? So if you're in a fairly high tax bracket this year, maybe you're working, maybe you have a lot of income from a capital gain, you might skip the first year to go into the second year, and we see people do that. If you're taking it in the second year, when do you have to take it by? It's kind of a weird, convoluted date. What? April 1st. That's good, Mike. You knew that. I don't know how you knew that, but that's pretty good. I helped you with that. Okay, yeah, it's April 1st of the following year. And then the second withdrawal needs to come up by December 31st. A normal distribution would be December 31st of the year you're supposed to take it. So every year you have to get it done by year end. Okay, makes sense? So what they do is they tally up everything that you have in your retirement accounts, and then they say, okay, well, we're going to divide it out. I'll show you these numbers here in a minute. Okay, here's a question for you first of all. Let's say that you have 5 IRA accounts. You have one at LPL, another one at LPL, another one at LPL, another one at LPL. You don't do business anyplace else but LPL, right? Better not be. There's no free lunch around here. So, but let's say you have an IRA here, IRA at Vanguard, IRA at Ameriprise, IRA at TCF Bank, IRA someplace else. Do you need to do a required minimum distribution from each of those IRAs? Nope. What they let you do is they let you sum it up. And they say, okay, you just need to take a distribution from one of them, but it has to equal what the total should have been, okay? How about if you have a 401k because you were at another employer, 403b because you're at a nonprofit TSA account, and 5 IRA accounts. Can you tally up the total sum and take one distribution? Mm-mm. Well, no 401ks, they're all pre-tax. Okay, so with a 401k, you have to take a distribution from each of those 401k, each of those retirement accounts. So if you have 3 employers or three different accounts at 3 different employers, you need to take a distribution from each one. Here's where it gets confusing. Excuse me. So I have a client, Mark, 60 years old. Mark helps mom manage her money. His mom is 85 years old. Lives down in Arizona. Dad passed away, and Dad managed the money and had money at Vanguard, Ameriprise, SIP Mutual Fund Company. They still have the 403b TSA of where he used to be a teacher, and a couple other little accounts. So Mom gets all these statements coming in on an ongoing basis. She gets proxy statements, voting statements, semi-annual reports, monthly reports, quarterly reports. And she stacks up all this mail for Mark to look through. And then he goes down there a couple times a year. And in this nondescript envelope, there's this little thing called your RMD notice. Okay? What if Mom accidentally got rid of that piece of mail? Yeah, what happens if you don't get that RMD done? What's the penalty?
Big time.
It's actually 55% taxation if you don't get it done on time. So the retirement account, the trustee or custodian has no obligation to get your money out for you. They just have to notify you. It's a negative consent letter. While we would suggest to retirees consolidate when you retire. You know, I wouldn't suggest having accounts spread all over the place because it gets a little bit, you know, crazy. Just do a self-directed IRA. You can have all your different investments in one IRA account. Make sense? Now, what they do here is once you tally up your year-end balance from the prior year, they say, okay, we give you this table, and this table will give you an idea of how long we expect you to live. So if you're 70, they're going to give you 27.4 years. That's not too bad for a lot of us in here. I'd take it. So they'd say, okay, you need to divide your retirement account balance by 27.4, and that'll tell you how much money you take out in that tax year. Another way of doing it is take 100 divided by 27.4, and that'll give you a percentage. In this case, it's 3.65% of your retirement account balance needs to come out. So we get retirees that are freaking out. Oh, we have to do an RMD. We're going to lose all our money to the government. You know, kind of makes you feel a little uneasy. It's really not that bad, is it? 3.65%? It's not the end of the world. If you're not making at least 3.65%, you're in the wrong place. So your account's probably growing at more than what they're making you take out. Even when you're 90 years old, they say, okay, it's 11.4-year distribution, which is 8.77% of the balance. That's not too bad. Where it starts to kind of add up is if you have $500,000 in your retirement account, and they say, okay, well, you have to take out, divide by 27.4. Well, now you have $18,000 more of taxable income. But if you have $1 million in your retirement account, now it's $36,000, $37,000 more of taxable income that you can't avoid. What's the only way of avoiding this taxable income on the RMD? No? Donate to charity, right. Have the RMD go directly to a charitable organization. You can't do a Roth conversion. It's too late on RMD. You have to do that beforehand. Capital gains. The only thing I want to discuss here is mutual funds that you own in your portfolios. If it's not in a retirement account, the mutual funds are continuously buying and selling stocks and bonds in order to get as much gain as they can. And every time a mutual fund, if they buy a stock and it goes up in value and they sell it, they have to distribute that capital gain to you as a shareholder on a year-by-year basis. So you probably haven't noticed this very much in the last 10 years. The mutual funds haven't had a lot of distributions because they've had carry forward loss from 2008. But now, just be prepared because, your 1099s on the funds are probably going to be a lot higher than what they've been in prior years. So you might have a little bit more tax to pay than what you thought. Okay, so this one here will make your blood boil a little bit. If it's not hot enough in here, we'll get it even hotter. It's called provisional income tax. So in 1982, under the Reagan administration, there wasn't enough tax revenue coming in. So they said, well, let's do this. Let's tax Social Security benefit income. So you're going, well, how can they do that? You're paying a tax to build up a retirement account, but then eventually when you take it back out, they're going to tax it again. And that's what this is all about. In 1993, the Clinton administration, Reagan administration said we can tax up to half your Social Security benefit amount. And then the Clinton administration said we're going to tax up to 85% of your Social Security benefits. So it's even higher yet. They set these thresholds back in 1982, and they haven't raised the numbers since. So they haven't indexed them for inflation. They've been just stuck where they're at, unfortunately. How they figure out your taxation of Social Security benefits They take your ordinary income from pensions, IRAs, wages. They add your dividends and capital gains along with your tax-exempt interest. This does not include Roth IRA income, okay? Plus, they take half your Social Security and that they tally it toward the provisional income balance. All right? Add those up, and that's your provisional income. And then if you're in these threshold brackets, so if you're single, if you're over $25,000 of provisional income, they'll start to tax your Social Security. If you're married, filing jointly, if you're over $32,000, they'll start to tax your Social Security, okay? So as you approach retirement, or if you're already retired, you might get a statement that says, okay, your Social Security check's going to be $2,500 a month. And you go, cool, I'm going to get 30 grand a year from the government. But then you start collecting your Social Security throughout the year, and end of the year, you go to get your taxes done, and you go, boy, oh, a whole bunch of tax. Where'd that come from? Well, they're taxing your Social Security. So when you apply for your benefits, they don't ask you if you want tax withheld. You have to go online and get a special form. So the $2,500 all of a sudden gets whittled down to, maybe $2,200 if you're not aware of this. So a couple examples. Here's a couple that has $20,000 of Social Security coming in, and they have $40,000 being withdrawn from their IRA account. So their total provisional income is $50,000. You know where I got that from? So half their Social Security, which is 10, plus the 40 is 50. So how the taxes work, anything over, or first you take your $50,000, that's provisional income, subtract the $32,000 threshold, because that's not going to be taxed, and then there's a 50%, or 50% of the benefit is taxed over that 32. So that's $9,000 there, and then we add in the additional 0.35 to get it up to 8.85. There's another $2,100 there, and so total $11,100 of their Social Security is subject to income taxation, or 55% of their Social Security is being taxed. So here's an example, just kind of turning this a little bit. So the first example was of somebody that's delaying their benefit. Let's say one of the couple was delaying, or one of the married filing jointly. Second example I'm giving here is they say, well, let's draw our benefit. Let's both draw our benefit $40,000 a year, and then we'll take less from the IRA, so their provisional income is less. So if you run through the numbers, then now in this example, only $4,000 of their Social Security is taxable. First example, I had $11,000 is taxable. Second example, $4,000 is taxable. So if you look at the tax rates, on the first example, their taxes would be $2,500 a year. Second example, their tax is 0. Okay? So now both couples have the same amount of income coming in, but the second couple has a tax savings of $2,500. So that's, a couple $100 a month more of income. Can you think of something you could do with a couple $100 a month? Could Rita think of something to do with a couple $100 a month?
Shoes.
Shoes, yeah. So if you can't think of something to do with a couple $100 a month, well, maybe you could reduce your IRA distribution and just save that money. But here, again, we're trying to increase your retirement income stream by decreasing your taxes, or increase your portfolio return by reducing your taxes. So Ray, this is for you. This is taxation of Social Security. So if you take $1 out of your IRA or your 401k, it could create 85 cents of tax on your Social Security benefit. Or 85 cents of your Social Security would be counted towards taxation. Every dollar that you take out of your retirement plan, it creates $1.85 of taxable income. If you're in a 19% tax bracket, where do I get the 19% from? I said, okay, 12% federal and then 7% state, 19%, still lower tax bracket. So at a 19% rate, you pay 48 cents on that dollar you just took out of your retirement plan. So it's effective tax rate of 48%.
That's a good deal.
Yeah. Check out this deal right here. Here's somebody that's in a 47% tax bracket. How can that be? If you're at the top of the tax rate chart at 37%, plus 10% Minnesota tax, that's 47%. Okay? So that's effective tax rate is 87% on that dollar you took out. All right, here's one for you. Daddy, what does IRS stand for? Income Redistribution. Harold. Okay, how much of your last dollar do you actually lose to Uncle Sam? That's what we want to answer. Going back to our tax maps, a little bit easier to see. We have our ordinary income tax maps. We have our long-term capital gain tax brackets. I'll go through a case study here. So here's a couple, John and Jane. They're married, filing jointly. They're 65, $60,000 of combined Social Security income. They have a long-term capital gain, and they have $45,000 of RMDs that they're taking out. So in this case, we ran the projection, and it gets like really unusual because we're thinking, okay, the red that I showed you earlier, the 0%, the 10%, the 12%, the 22%, but in their case, they never even touched those lower brackets. It goes from 18.5 to 22.3 to 50%. And this is only federal taxation. Pretty scary, huh? So there's peaks here that you could be hitting on your distributions that are being taxed at 50% plus state tax, could be up to 60%. You definitely want to avoid that right there. So if you're using TurboTax or doing it by hand, you will not see this. So the only way to see it is with tax mapping, okay? So again, we run these scenarios. You don't necessarily see them. If you're interested, I could just show you next time we meet up. So how did this happen? You know, you think, okay, he took an IRA withdrawal of $1,000, $120 of tax. Should be in the 12% tax rate. But what happens is there's 12% tax on $1,000. Plus, we have the Social Security tax, another 120 bucks there. Plus, the capital gain that they realized didn't fall into the 0% rate. It pushed over the marginal amount of that $77,000. Now it's being taxed at 20% instead of 0%. Add those up, it's $499 of tax on that $1,000 distribution. So again, you know, what we want to do is try to, you know, run these calculations on an ongoing basis and look at it moving forward. So what is done for last year, but what combination should you use when you do distribution? So my Tuesday appointment with a retired control data employee, I've known him for years. Every year we sit down and do this, and we figured out, he said that he needs $70,000 from his accounts this year to supplement his pension and Social Security. He needs $70,000 out. We did a tax map, and we said, okay, let's take $60,000 from your IRA. It's going to be 12% federal, 7% state. And then we'll take the other portion, it ends up being about $26,000 from his Roth IRA, zero tax. So not a bad deal. So he kept himself, he never hit these spikes. You know, we kept him in the valleys. And he was a client that was fortunate enough over the last 5 and 6 years, we've done Roth conversions. You guys heard of Roth conversions? Yeah, so year by year, he didn't need that kind of income in the last 5 years. This year he's doing a home remodel, doing some traveling, etc. So in the years that he didn't need that kind of income, we've been doing Roth conversions at a low tax rate. But now it's pretty cool because he has this big Roth IRA account that's all built up and you can use it tax-free anytime. Okay? The IRS, like the sign says, it's all theirs. So here's some of the tools for tax control. We talked a little bit about IRAs, Roth IRAs. Properly blend withdrawals from different accounts. Consider which assets should be held in which account. Kind of the comments, just some general comments in this area here. You know, just kind of looking forward and talking about these new tax law cuts. So So you might feel, if you've kind of done some projecting on your own, you might be going, okay, the new tax cuts didn't mean a lot for me, or maybe your taxes have gone up. However, I would, just knowing this group here, I would say there's a lot of people in here that have $1 million or more in stocks and the stock market, right? Even if you have $100,000 in the stock market, you just got the biggest tax cut ever in your lifetime. You know why that is? If you own a company stock, the government just cut your tax rate from 35% down to 21%. So if you own a company that has $1 million of profit, you just got a $140,000 tax cut. If you have a company that has $1 billion of profit, you just got a $140 million tax cut. And guess what? If you're a stockholder, that's coming to you real soon, right? Where are all those earnings going to go? Companies are going to get the earnings, and they go, well, what do we do with this? We have to pay tax on it. Well, gosh, our tax rate just dropped significantly. And the corporations are going, I mean, it's huge. That's a big, big tax cut. So when you see this market that's gone from 16,000 to 17,000 to 18,000, 19, 20, 21, 22, 23, 24, 25, 26 this week, it's real. You know, the earnings, stocks follow the earnings of the companies. The earnings are the best I've seen ever, okay? So as the earnings go up, and we haven't seen all the earnings going up yet because the tax, you know, the bean counters at the companies haven't, that, you know, the profits haven't come in, they haven't, you know, realized all that reduced taxation quite yet. What companies do you think are going to benefit the most from this tax law cut? What kind of corporations? Tech. What else? Health. All good answers.
Professional football.
I would say the types of stocks, you know, that LPL corporate, so we have 14,400 or so advisors nationwide, independent advisors. Our corporate office has 40 full-time chartered financial analysts. We have 3 full-time PhD level economists. What they're saying is that the companies that will benefit the most are the small-sized companies here in the United States and the medium-sized companies in the United States. Because guess what? They don't have a multinational headquarters over in Dublin, Ireland, you know, like Apple or Medtronic or Pentair. So those big multinational corporations already have a low tax rate, right? They're going to just decide where they're going to bring their profits, here in the United States or keep it internationally. So the small cap, mid cap stocks, we've already rotated. We've already reallocated portfolios to that. International is coming around. Keep an eye on those stocks, but I would stay more domestic this year with the portfolio and realize the benefit of that tax law cuts. So if you didn't get it individually, you're probably already seeing it in your portfolio. I'm going to wrap up here, and this is a mountain. This is actually a picture of Mount Everest, of all places. So people pay $100,000 to hire Sherpas to climb Mount Everest. The death rate is 1 in 1,000 climbers will die on this mountain every year. Pretty crazy, huh? Where do most of the hikers die? Going up or going down? That's true. Yeah, descending the mountain. And so going up, you've done that. Most of you in here are retired. You're successful. You've built up your portfolios. That's might even be an easier part because you can keep investing, keep going for growth, and you know you can ride out the market corrections. Descending the mountain, we specialize quite a bit in that area. So there's things that we're very aware of, like, okay, well, how do you keep your taxes down so you have more money to spend and more money in your portfolio? We talked about that tonight. There's this thing called sequence of returns. If you've never Googled it or if you want a white paper on it, let me know. Called sequence of the returns. So if you don't do this right with your portfolio, it could be the wrong step and you're going to run out of oxygen. Your portfolio is going to be down to zero. We run into too many people that, come to us and their portfolios are allocated very poorly and they don't, might be taking too much risk or not enough risk. So what we want to do is help you. Our clients, where we got the name Summit from, we weren't necessarily thinking about the mountain thing. We weren't necessarily thinking about the beer thing. Although when we were brainstorming for names, it did help a little bit. We weren't thinking about the prestige of Summit Avenue. We're thinking about this. We're thinking about, and when done right, reaching the summit is much more. It's a collaboration of the minds where more is accomplished than ever imagined. So we're thinking of a summit meeting with y'all. So, how do you're all smart, you're educated. How do we get together? How do we best help you to accomplish your goals? Okay? That's what our company's all about. You already know about the importance of the plan. You probably know most of us that are working here now. And with that, thank you for attending tonight. Let's put our hands together and do the Vikings cheer. How does that sound? All right? 1, 2, 3, Skol! All right. Thanks for coming tonight, everybody.